Hello, future CPAs. Today we are here to discuss about uh, two of the modules from the FAR syllabus. It's income taxes part 1 and part 2. Well, there is a certain concept of income taxes that we lag behind, where I think most of the students struggle in understanding it and then finally attempting the questions in short span of time. So it becomes a challenge for them. So therefore, we are here to discuss the whole concept of income tax, and I'm sure it's not going to take long because I've just created an example on my own, which would deal with the concept very clearly and would finally make uh, each part of it crystal clear in your mind. And I hope that you're successful in at least drawing a mind picture when you're doing a picture in your mind when you're doing when you're attempting the question in the exam, so that you're able to do it in a very quick manner. So okay, so let's just move on to the example straight away. Although I have noted the example, but I would just love to do it again for you guys, because I think that way you'll be able to follow it in a better way. So for just understanding that example, I think there are two equations you need to understand very well, because the whole example is based on it. Of course, we'll be dealing with deferred tax assets and liabilities throughout the chapter. That's the main part of it. So the two equations that I was mentioning is that there is a difference. Of course, there is a difference between tax expense and the current tax that we pay. They're not equal. Of course, they're not equal, because current tax is something that we pay it today. Obviously, when we study tax, when we prepare our returns as per income tax, when we are paying the taxes, there is always a difference between the financial reporting, what we do, and the income tax return. So in order to finish off that difference, not just finish off, but at least to make peace with it, the deferred taxes assets and the liabilities, they come into play. So therefore, we need to firstly understand there is a difference between tax expense and the current tax that we pay. Tax expense is something that is based on accrual based accounting. So tax expense can be more than what we are paying right now, or it can be less than what we are supposed to pay right now. So therefore, there are two equations, which are tax expense is equal to current tax. Now there are two terms, of course, deferred tax asset and deferred tax liability. Now deferred tax asset is something. Why is it an asset? Because the taxes, there are certain items on which we have paid taxes today, which we were not supposed to do it today. So therefore, it has created an asset. It has created a benefit for us, an income tax benefit for us, which we are going to reap in the coming years, in the future years. So therefore, the today's tax expense is equal to the current tax on the income tax expense less the deferred tax asset. This is something that we were not supposed to pay today, but we have still paid it. It becomes an asset for us. It's going to land up in our balance sheet on the asset side, of course. Just similar to this equation, the tax expense, if we have deferred tax liability, it's of course going to be the opposite of what we did in the earlier equation. So it's of course going to be adding up the deferred tax liability. Why? Liability is something that we are supposed to pay today, but we haven't paid it. We haven't paid it yet. So we'll be paying it in the later years, in the coming years. So therefore, It's a liability for us. So the tax expense, today's tax expense, is how much the current tax that we've already paid, adding up what we are supposed to, the things that we were supposed that we've already paid, something that we're paying in future, but it is today's expense, this year's expense. So therefore, it is tax expense. So if these two equations are clear, I think the example would be very easy for you to understand. So yeah, moving on to the example. So this is the example that I've created with the following information. The accounting income, or the income as per the financial reporting, it is $80,000. The taxable income comes out to be $99,000. I'm sorry. There's a temporary difference. Now, of course, before doing this, I hope you all have studied the chapter at least once. So we know that what are temporary difference and what are permanent differences. I am not going to explain it over here. Sorry for that. Okay, so temporary difference is coming out to be $9,000, and the permanent difference is coming out to be $10,000. Now I am going to do this question. I'm going to solve this question in a T-shaped accounting based. I think most of you know the T-shaped accounting. This is something that we very commonly use in India for understanding everything as to where the things are going, where the things are being placed. So therefore, I'm going to use the same way to do it. So I will be drawing this income statement and this balance sheet parallel to it. Yeah. So, of course, we have the accounting income over here. That is coming out to be $80,000. There is tax expense. Of course, tax expense is going to come over here. Now, tax expense is going to have two parts. Why two parts? Because we have the current tax that we are paying right now and the deferred taxes part. So, of course, it's going to have the current tax and the deferred tax part. Now, how to do it? So, I'll be making some notes to the accounts. It's just a rough work that I'm doing for a better understanding. It's deferred tax or the timing difference. I'm making an account basically. Adjusted closing balance, the tax rate, DTA and DTL. So in year one, what happened? There was, it's a timing difference account. So of course there was a $9,000 temporary difference. Of course, nothing is done on the permanent difference. It's never going to get reversed in the future. So of course, no deferred tax would be created on that. So we'll be dealing with only the temporary difference that comes straight away from here, 9,000. Nothing is adjusted. The closing balance of the timing difference is $9,000. Now we have the tax rate. I think I forgot to give the tax rate. The tax rate as of this year one is 30%. Now, FYI, in US GAAP, we always use the enacted rate. Enacted rate is basically the rate in which the rate of the year in which we expect the deferred tax asset or the liability to get reversed. So that's the enacted rate. It's 30% as of this year. So of course, if you calculate it, 9,000 into 30%, it gives you a deferred tax asset or a liability of 2,700. Mind you, I've not decided yet whether it's a DTA or a DTL. We'll work it out. Okay. Now, since it's a positive temporary difference, See, positive, how positive? The accounting income was 80,000 and the taxable income is 99,000. Taxable income is more than the accounting income. That means we're paying more of taxes as of now. So we'll be getting the benefit in the future years. So when we pay something more, when we're paying taxes more, in this year, it's going to be definitely a deferred tax asset. So I'm just marking it as a deferred tax asset. So when deferred tax asset is to be created, it lands up where? In the balance sheet. This is the final deferred tax asset amount that should be sitting in my balance sheet today. As of the end of the year, this deferred tax asset is coming out to be 2,700. Mind you, in India we have the asset side on the left hand side. On the right hand side, and the liability side is the left one. So therefore, don't get confused, foreign students. So yeah, you can do that just the opposite way. So okay, yeah. So just continuing with the question. We have a current tax payable sitting on the liability side of the balance sheet. How much that would be? Current tax payable would be a taxable income into 30%. What we are supposed to pay today, which is 29,700. I've pre-calculated it. So don't worry, the calculations are absolutely okay. Okay, so this was it. Now, when we have to create a deferred tax asset, 2,700, what happens? The current tax payable, how does it come over here? Well, the tax expense, this year's tax expense is 29,700, and the deferred tax asset that I have to create would sit over here. When I have to create a deferred tax asset, 2,700 would definitely get reduced from here. This is something I have to create. When I have to create an income tax benefit, it's a benefit for me. So basically, it is getting reduced from the expense side. So my total tax expense comes out to be 27,000. So this is what I was explaining. If we look at the equation, it is clearly being depicted in the T-shaped accounting form. This is the tax expense. The current tax and the deferred tax forms part of it. It's a deferred tax asset that I have to create. It's something that is benefiting me. Of course, it's going to get reduced from the expense side, which makes my tax expense reduce to 27,000. So there is a difference. Of course, you can parallelly see the difference between what we are paying today. We are paying extra. The tax expense is 27,000. We're paying extra 29,700. Of course, that would be creating a deferred tax asset for me. That is 2,700. This was a very basic thing. We'll be complicating a little bit of it. Now, this was year 1. Mind you, this was year 1. We'll be taking year 2. The example still continues. This is not a separate example. It's continuing. So what happens year 2? I'll give you more information. This year, the accounting income was $90,000. There was certain permanent difference. Permanent difference of $2,000. There were certain temporary difference that was totaling up to $6,000, a positive temporary difference, of course, and the total taxable income comes out to be 98,000, which is again more than the accounting income. So just saying these two figures, I'm pretty sure that this time also we are going to create a DTA. Okay, so let us, and of course the tax rate has changed. Tax rate this year has become 40%. Now what happens? Now when we know the tax rate has changed to 40%, now we'll be making the notes again, notes to the accounts again, similar to what we made earlier. So I'll be taking year, created, adjusted, closing balance, the tax rate, and again the DTA and the DTL. Now in year one, we had $9,000. We had created $9,000. Nothing is being adjusted this year. Adjusted means nothing has been reversed this year. So closing balance still stays as $9,000. Now the tax rate has changed. It's going to get revised. Our deferred taxes are going to get revised at the revised tax rates, 40%. Now it is 3,600. We know that it's an asset. It's a DTA. Now in year two what happens? I'm just sorry, I need to revise this. It's 35%. It's 35%, guys. It's 35%. It comes out to be 3,150. Apologies for my mistake. Yep, it's 35% this year. In year two, what happens? There is a 6,000 temporary difference. Of course, we are going to take that into account. 6,000, nothing is being adjusted. 6,000 again, the closing balance of this particular timing difference, 35%, the tax rate, and 800. I'm sorry, 2,100. Now 2,100, we already discussed, it's again going to be a DTA because the taxable income is more than the accounting income. When it's coming out to be more than that, an asset has been created. Now moving on to the T-shape accounting, the representation. Now the income statement, the balance sheet. Again, I'm going to do it the Indian way of it. I'm going to take the asset on the right side and the liabilities on the left side as far as the balance sheet is concerned. Income statement. Now when we are posting this thing, we're posting everything on the first. Let's deal with the accounting income that we have here. Accounting income is $90,000. Okay, now to the tax expenses. Now mind you, the account that we created over here, this has been revised at the new tax rate. So the new DTA or DTL, whatever it is. Now since here both are DTA, so of course deferred tax asset, so both are positive. Now the final DTA that should be sitting in my balance sheet should be how much? It's 5,250. This should be something, this figure should be sitting in my balance sheet as far as DTA is concerned. Now when we are drawing the T-shape accounting here, the tax expense, of course, current tax being a part of it. Current tax and deferred tax. Now, in the last year's balance sheet, let's first just discuss about the current tax that is payable. Current tax is how much? Current taxable income is 98,000 into 35%. That comes out to be 34,300. So this is something that is payable. It's going to the liability side. Again, the current tax payable comes out to be $34,300. So this is something that we'll be paying the authorities today. Moving on to the deferred tax. Now, how to deal with deferred tax? Now, last year, if you would have noted, in the last year, our deferred tax asset was 2,700 in our balance sheet. This year, our balance sheet should show this amount, this balance. This is the revised deferred tax asset which should show. Whatever the difference is, whatever the adjustment is, they are going to land up in the income statement. So there would be a further $2,550 amount reducing from the tax expense because the deferred tax asset balance has increased to 5250 from 2,700 as per the last year's balance. So adjustment is going to happen over here, part of this, and finally the tax expense is going to come out to be $31,750. So this was end of the second year. Now the example is still continue. I promise this is the last part of it. So last year, year 3, what happened? Let me give you some more information. Now this year the accounting income was $110,000. Well, the company is progressing. There was a permanent difference of $6,000. There was a temporary difference. Mind it was a negative temporary difference, $2,000. Negative, just to mention, negative difference is basically where it's a negative temporary difference where it's basically where you were supposed to make the payment, maybe it has been disallowed. Maybe it has been, there's a negative temporary difference. I will just mention that and let me explain it later in the same question. Okay. And there's been some reversal of the previous differences, reversal of the temporary difference. Previous temporary difference, I think, is 6,000. Year 2's temporary difference is being reversed. I don't think so that AICPA is going to give you such a complicated question, like this complication of reversal, but I am just mentioning, it's worth mentioning as to how the things would happen further. So I'm not pretty sure that they'll give such complication. So the new tax rate is 40%, and the total taxable income comes out to be $108,000. So so this is the information for year 3. let's move on to the notes to the accounts that we'll be making. So year um, created, adjusted, closing balance, tax rate, DTA or DTL. Now what happens is, in year one's timing difference was $9,000 that we had created earlier. Year one, year two, and year three. Okay, so of course we have not adjusted anything as of the information, so 9,000 still remains the closing balance of this particular timing difference. Of course the new tax rate is 40%, so we'll be revising it at 40%. This is creating a 3,600 DTA. As far as year 2 is concerned, we had created $6,000. This is being reversed. This is being adjusted. So 6,000, our closing balance is nil. Of course, no DTA or DTA will be created of this thing. Now, in year 3, there is a negative temporary difference. Negative. It's a negative temporary difference. So when the temporary difference is negative, of course it's going to create a deferred tax liability. There's been no adjustment, it remains there in the closing balance, and 40%, this is 800, and this is a DTL. So mind you, there are going to be some expenses or incomes. Some are going to create DTA, and some are going to create DTL. Mind you, we'll be putting one final amount, whether it's going to be DTA or a DTL. We are going to take just one amount. That is going to be the net figure. So here it's coming out to be net 2,800 deferred tax asset. Let us make the T-shape accounting again. Income statement and the balance sheet. Now, what is happening? First, the accounting income. How much? We had an accounting income of 1,10,000 this year. Cool. Now to tax expenses. Current tax part and the deferred tax part. Let's just deal with the current tax part first. The current tax would be, of course, taxable income into 40%. That is how much? That's 43,200. This is going to go where? The current tax payable, the liability side. Woo! It's going to come in here to 43,200. Now, what about deferred tax? Well, this is the only tricky part in the whole example. The whole example was conceptual based, and just understanding the concept. There's nothing more than this concept in the whole chapter. As far as the whole chapter is concerned, yes, of course, there are certain particular adjustments that we deal with it, which are also very, very, very easy. So now coming back to the question, coming back to the example. Now the deferred tax. Now here the deferred tax balance, the final deferred tax balance is coming out to be 2,800. Now this is something that should be sitting in our balance sheet. This is the final amount. So let's just make it sit there. Deferred tax asset is 2,800. Now year 2's balance. Now year 2's balance. Year 2's I'm sorry, year two's balance sheet already had a balance of 5,250 in the deferred tax asset. Now this has reduced to 2,800. It keeps it can happen. Of course, it can happen. It would happen every year. Not I'm sorry, not every year, but it can happen very frequently. So, uh, deferred tax asset has reduced to this balance. When this balance has to be adjusted, there has to be some adjustment done over here. Now, when I have to reduce my DTA from this balance to this balance, there would be a positive balance. It would be an income tax expense, and I would term it as an amortization, but US GAAP has termed it as an income tax expense, deferred deferred income tax expense, which is coming out to be 2,450. It's just a difference between the two. When I have to reduce it, it's difference. So difference is going to come over here, and it is totaling up my tax expense to be 45,650. So this was the whole question. This was the whole representation as to where the things are moving from, and basically I think it's summing up the deferred taxes in a pretty good way. This is something that I explained it to myself while I was studying deferred tax, and I think after this concept was clear, there was nothing left in this chapter more to it. I'm pretty sure about that. So yeah, I think this is the whole question and the whole concept of deferred tax assets and liabilities. As far as income taxes part 2 is concerned, I think there is only one amendment that has happened, which is also easy to understand because they're given given to us with the help of an example, which is pretty self-explanatory. So that's, I think, yeah. So I'll end up here. Thank you so much.